Greetings. Keith Prather here again with the NCM September Marine Economic Update. Share my screen here real fast. So this month, the Marine Leading Index, and this leading index is a general economic barometer. It uses and incorporates 4 to 5 different economic indexes that all help us understand demand for marine equipment. And what we saw this month is, again, the index is very close to being right at the long-term trend line. So we'll look at this. We're watching this line right here. So it's staying within that long-term trend line, but it was down 4% month over month. There could be a little bit of seasonality there. But when we strip out the seasonality and we look at it on a year-over-year basis, it was down about 6.6%. So we do see some softening overall, and it's a little bit more than the usual trend. The index itself came in at 94.3, down from 98.1 last month. When we take a look at the producer price indexes, then this is another checkpoint to try and help corroborate and understand whether the index is performing the way it should be. We do see a little bit weaker environment. In fact, we got one of the weakest readings from the producer price index for boat building that we've had since going all the way back to 2017. It was down. It was relatively flat month over month, but it was down. Um, well, it's actually showing at 1% higher year over year, which I don't understand. Doesn't work with that chart. So, but if you take a look at the long-term trend line, still way down based on where it was, back prior to the peak. And we got the peak that came out in 2021, 2022 when everyone was coming out of COVID and we were hitting the post-pandemic era where we really still couldn't go out in public. We couldn't do a lot, but we bought a lot of boats, we bought a lot of RVs, and we were going out. We were being out in nature, and so coming off that peak, then everything has declined pretty significantly. I'll check that year-over-year figure here in a minute. But what's really driving this is real disposable personal income. So this real disposable personal income is the amount of money left over after consumers have paid their taxes and paid all of their major essential items like food, housing, utilities. And what we're seeing is that there's a direct correlation between what happens with like big ticket items like auto sales, marine, RVs, any of those big ticket items. There's a direct correlation between that and what happens with this particular figure. And so the latest update that we have through the end of July was that it was growing at about 1.1%. I think it was 1% in last month's update. That 1.1% is pretty sluggish when we look at it, not only just in comparison to the last 2 to 3 years, but also when we look at it historically, looking at decade averages, going all the way back into the 1960s. So there is some weakness out there, and we know it's out there. Now, for the full 2024, we're expecting it to be about 1.4%, which again is kind of lackluster. And then for 25, also about 1.4%, which is again not it's growth, but it's not a significant amount of growth. Now, a couple things here. Again, if the tax cuts that were passed in 2017 are not extended at the end of this year, then that would further dig into disposable income. You would see if those taxes come back onto consumers, that when we do adjust it for inflation, disposable income would actually be going down, and it will pull down some of these big ticket sales with it. The other thing that could happen though is as inflation comes down, that does help this figure. It kind of straightens it out and kind of flattens it out a little bit. So as long as employment and wages stay fairly stable, then we could see some recovery in this inflation-adjusted disposable income. But inflation is going to have to come down hard, and wages are going to have to stay stable. So the key factors that we are going to watch moving forward, it's the same thing that the Federal Reserve is watching. So this is Jerome Powell, the chairman of the Federal Reserve. And what Powell is watching is the gap between hourly earnings and the average annual growth rate and where inflation is. And right now there's a nice gap because average wages are growing at about 3.8%. And based on the latest inflation data that we have, they're right now running about 2.7%. So that full point of gap that we have between what we're bringing home and what we're having to spend with inflation, what inflation's eating, is that gap that helps people go out and take on loans, any of the big ticket item purchases, especially when you think about marine. A lot of that will come out of this particular relationship. And what we saw, if we go all the way back to the decade prior to the pandemic, you kind of saw that 1% relationship between inflation and between wage growth. And so that's important that we still see that intact, because without it, we have about 62% of the population, about 78 million households that are still being hit and living hard, check to check. Very difficult for them to dig out of their debt. Not all of those will be targets for marine sales, but it is a factor affecting total sales across the entire sector and across this entire category. So when we look at the macroeconomic forecast, a couple of things I want to point out this time around. First of all, Q3 was growing at about 2.5%. It's a little bit weaker than it was last year when we grew about 5%, but a lot of that is because we were building inventories, getting ready for the peak season. And we believe that this year we probably front loaded a lot of that inventory building activity in Q2. And then we get a normal Q4 that should be kind of in line with what we've seen historically. But a couple different things are also going on. Note that consumer spending, I talked about this before, but consumer spending based on contributions from the stock market. So when the stock market goes up, a lot of household wealth goes up with it. And as that household wealth goes up, those households that see their net wealth increasing have the ability to go out and borrow, and consumer spending kind of results from that. So last year, we saw with a really good, strong stock market, we saw about $900 billion in new stock wealth was created. That generated about $288 billion in additional spending. And we think that that was one of the catalysts that really helped marine, RV, and a lot of these categories grow. Now, the reason why I bring that up is because this year, we just hit a new all-time record in the Dow Jones Industrial Average. The S&P 500 is real close to that just this month. And September is supposed to be a fairly weak month for the stock market. So we may be getting on the back end of this year a very similar type of performance that we had last year, which could result in some better spending toward the end of this year and early into 2025. The other thing that I don't have a slide on, but I do put in the briefing, and we do write about it in the briefing a lot, is this whole great wealth transfer factor. A great wealth transfer is the notion that a lot of baby boomers are getting to retirement age. They're passing on, but they're getting to that stage where they're ready to do something with the wealth that they've created. And the baby boomer generation was one of the first to jump into mutual funds and the stock market. And so they have amassed great wealth. And so what's happening now is as they pass that wealth down to their kids, those kids are at the age now where they're out and they're looking at things like lifestyle changes, the fact that they suddenly get $1 million, $1.5 million dumped in their lap, allows them to go out and take on something like a new boat loans, RV loans. And so we're watching that great wealth transfer because it's going to accelerate over the next couple of years. And we think it will be a factor in overall sales in this category. So that's what we had for you this month. Again, a little bit of near-term weakness in the data, but what we're watching is a little bit longer-term optimism. And we think that once we get through the election, we get a little bit of a Fed interest rate cut, probably sometime this month. We'll get at least a quarter point cut, followed by maybe another quarter point in December. That will help spur some of these sales, and we'll start to see a little bit of an increase in activity on the marine front if everything else stays stable and the data remains kind of the way we see it today. So I hope this was valuable. Reach out to me if I can answer any personal questions, and hope you're doing well, and take care. Bye bye.